All right, so we are on to our next topic. Um, we're going to jump into bonds issued at a premium. There may be a couple of other things in addition to that. This one doesn't quite go as long, but we'll see. Um, so we had that prior example that we had started. We're just going to kind of continue with that one rather than redoing a bunch of numbers. So what's going to be different between this one or this problem and the discounted bond? So just remember with the discounted bond, the interest expense, it was the sum of the interest payment and the amortization of the discount. Those two things combined to give us the interest expense. And so how is it different here? Well, in this case, the premium has a credit balance. It's a normal liability. So it has a credit balance. And so as we amortize that premium, we will debit the premium. And so if you think about what that will do is then the interest expense, it becomes the difference between the interest payment and the amortization of the premium. So conceptually, the issuer has borrowed, something above the face amount, right? So conceptually, economically speaking, they've borrowed more than that. And so over time, not only they're paying interest, but they're actually paying down the principal so that when the final bill comes due or that bond payable is due, the carrying value, the amortized cost will be equal to the par value. So they're paying interest and paying down the principal in concept, sort of that, like economically speaking. All right, so in our example, again, we're just continuing our prior example. We take the information from the information above and we throw it into our TVM table. And again, the elements that are given to us is our N is 20 because it's 10 years of semi-annual periods, so 20 semi-annual periods. Again, contractually, they agree to pay $1,000 at maturity, and they're going to pay $40 of each interest payment based upon the 8% bond rate. And then the price we were given at 102, which is right over here. And of course, that's the amount that I'm receiving as 49 companies, so it's a positive cash flow to me. When we solve that, we get 3.8547. Again, that would be the semi-annual yield, which again we would expect and is slightly less than the semi-annual bond rate of 4%. So much like we've been doing, we then create the amortization table. Again, with the premium, though, the difference is we're starting at an amortized cost that's above the par value. And over time, that amount will get reduced to the amortized cost so that at maturity, the amortized cost will be equal to the par value. And again, we have the payment that never changes, and the interest expense is the yield times the prior amortized cost. The amortization is the difference between the two. And of course, over time, we're reducing the premium balance. So if you remember, the amortized cost was the par value minus the discount balance. But in this case, because it's a premium, it's the par value plus the premium balance gives us the amortized cost. And of course, then, just like with the discount bond, this table serves as the basis for all of our journal entries going forward with this bond. And so on June 30th, 2025, we're going to kind of record that payment. Again, taking note that there are 500 bonds here. And so the cash payment is $40 per bond times 500 bonds for a total cash payment of $20,000. And then we have the amortization of the premium, 68 cents per bond times 500 bonds for a total of 340. Now remember, the premium has a credit balance, so the amortization is a debit to that account. You could fill in the interest expense, but we can also directly calculate it. The interest expense is $39.32 per bond times 500 bonds for a total of $19,660. Continuing that same process for December, of course, we have the cash payment that didn't change. The amortization of the premium now instead of 68 cents per bond is 71 cents per bond. And then, of course, the interest expense is based on $39.29 per bond instead of $39.32 per bond. Again, so same accounts, just slightly different amounts. And so what we see from those two tables is basically, if we're talking about the premium we just covered, that we sort of follow this arc when we go from the initial amortized cost to the final amortized cost or par value. And so over time, as the bond gets closer and closer to maturity, it will sort of accelerate towards that par value. On the discount side, of course, it's a similar curve, but instead of curving downwards towards the par value, it's curving upwards from the lower amortized cost up to the par value. But again, the amortization increases with an increasing rate the closer we get to that maturity date. All right, so you may have a situation where you need to accrue interest in between interest payment dates. Two situations where interest payments may not coincide with a fiscal year end. One, it could be that the bonds just pay interest on a date other than the fiscal year end. It also could be the case that the company prepares interim financial statements, either monthly or quarterly or whatever it is. And so in that case, those would require some sort of accruing of interest, even though an interest payment isn't taking place. And so one obvious example of that was the zero coupon bonds because there was no interest payment. And so the interest in between interest payment dates was each fiscal year end. And so what do we have to do is we had to accrue the interest and amortize the discount. And so now what we have is basically an extension of that situation. So as a practical matter, just so you're aware, most interest-bearing bonds are going to pay interest on December 31st. So unless there's a different fiscal year end or for whatever reason they don't coincide the bond with their fiscal year end, there's really not going to be a reason to sort of have this first situation up here. Very commonly, though, you might have the second situation where you do need to accrue something that for a date that doesn't coincide with a fiscal year. And so it might be a monthly report or a quarterly report or whatever it might be. So if we kind of think about our prior example that we were just working on, this is that discount bond. And let's just say that we wanted to create an interim report for Q1 of 2026, which would be March 31st, 2026. And really what we got to think about is that, 6/30/2026, that row in our amortization table, it really covers the 6 months that end June 30th, 2026. And so March 31st, 2026 would land in that 6 month period. And so this is the information we would use in order to prepare that March 31st Q1 report. And so that's what we're going to kind of bring up. And so looking at that, we have to kind of calculate three different things. First of all, we have to figure out, okay, is there accrued contractual interest that would be based on the interest payment? Whatever that amount is would be a credit to interest payable because it is a contractual obligation to pay. You also would need to partially amortize the discount. Again, so a full 6 months of amortization is 69 cents per bond. But of course, this would capture basically 3 of those 6 months. And again, the discount has a debit balance because it's a contra liability. And so to partially amortize that, we would be crediting the discount on bonds payable. And then finally, we do need to accrue the interest expense. Again, a full 6 months is $45.69 per bond. But of course, this is only 3 of those 6 months, but we would still debit the interest expense for whatever that amount is. And so for our first calculation, accruing the interest payable, again, $45 per bond, 600 bonds, again, 3 out of 6 months because March, January, February, March, 3 months. Partial amortization, again, 69 cents per bond times 600 bonds times 1/2 is 207. And the interest expense is $45.69 per bond times 600 bonds times 1/2, which is $13,707. So bringing that information into a journal entry hopefully isn't too bad. Again, we're going to debit the interest expense and we're going to credit the discount and credit the interest payable. So again, this is accruing the Q1 interest on the bond. All right. Next kind of mini topic, how do we handle the cost to issue debt? The book goes into a lot of length on how to do that. And so I'm just going to kind of summarize the two approaches here. One is the use of an underwriter. It's like Goldman Sachs or some other big investment bank. And essentially what happens is the company issues their bonds to the underwriter, and then the underwriter sells them to the market. Now, typically for the underwriter, that first sale is a fairly limited number of usually institutional, high net worth insurance companies, those types of investors. And so they're not like going out to everybody, but essentially they take on the bonds and then they resell them, and then those groups might resell them after that. But essentially, that's what facilitates that market price. And so typically the underwriter is going to pay a little bit less for the bonds than what the market's paying. And that difference becomes their fee. But understand there's like a negotiation. So most often the underwriter has already worked with their institutional investors to figure out what a fair interest rate on the bond would be. And that's going to depend on the company. It's going to depend on the size of the issuance. It's going to depend on what they plan to do with the issuance, the business plan around using the cash. So there's a lot of factors that would go into the way those bonds would get priced. But basically the investment bank's job is to figure, okay, how do I get them the money they need, right? Because the reality is whoever's issuing the bonds needs cash. How do I get them the amount of cash they want for the lowest interest rate possible? And they do that through all of those conversations and trying to minimize the interest that they would have to have their client pay. But anyway, so that's kind of a normal process when they use an underwriter. And you can probably see why in many cases when you use an underwriter, it's not going to be issued at a discount or a premium because everything's kind of been pre-negotiated. Now, there is a little bit of a delay between when everything's pre-negotiated and when all the final paperwork is done. And there could be a situation where information has changed, and so maybe there's a discount or a premium, but largely they're going to be issued at par. The other approach is what's called a private placement, and that's with a bank or insurance company. So there's really no public registration because the only people that are going to be able to own these are private institutions, and so much less expensive. But you also have to, it's sometimes more difficult to get them issued because you have to find a bank or insurance company that's willing to take on the entire debt amount, which is not always easy to do. So how do we handle it? So one option would be to just expense them, right? So whatever I pay fee-wise, just expense it. But that kind of would mismatch that expense with the benefit. And the reality is you're going to hold these bonds for maybe 10 years and you're going to realize the benefit of those fees over those 10 years. And so one other approach, and the approach that we use under US GAAP, is instead just take whatever those fees are, and that reduces your net proceeds at issuance, which then kind of rolls into a change in the effective interest rate or the bond yield. And so essentially those fees get factored into your interest expense. And so rather than having some sort of like legal expense or issuing expense as a one-time charge, you're going to have a slightly adjusted interest expense over the life of that bond, which really is probably a more accurate reflection because it really is the cost of your debt. And that usually is what we call interest. And so that's really the process that we use rather than tracking it as a separate expense. And so in this example, they issue 420-year semi-annual bonds at 103, so it's issued at a premium, but there is a $10,000 cost to issuing the bonds. And so they're going to pay bonds twice a year, and the rest of it's pretty standard. There are two approaches. You could allocate the cost to each bond, or you can just sort of do an aggregate calculation. You'll get the same answer no matter what. I personally do the per bond. I do the per bond allocation, and so we take that $10,000 and we allocate it to each bond, which would be $25 per bond, which means really on a per bond basis, they're not getting 1,030. Really, they're netting $1,005. Again, this is just sort of the way to view this from the economic transaction because that's what they're actually receiving. And so we take that information. Again, you can pause to kind of work on this on your own a little bit if you want to, but basically that does get thrown into our TVM calculation. And so, 40 is the number of semi-annual periods. The amount that we're receiving net at issuance is $1,005 per bond. The bonds pay $50 twice a year. And in total, or at maturity, we're going to pay 1,000. So the yield on these bonds is 4.9710%. Again, because it's a premium, we would expect, and the yield is slightly different than the semi-annual bond rate. From there, then we create our amortization schedule just like we normally would. Of course, I'm only doing one row here to keep it simple. The goal would be at this point, this is actually fairly straightforward. But the issuance of the bonds, again, we don't do anything different because there were costs. We just simply, the net cash that we receive is a little bit less than if we hadn't had any issued costs. And of course, then that means the premium is a little bit lower than it otherwise might have been. And then we have the next interest payment. Again, the goal would be that by this time, this is very straightforward. Again, we're just using that table to fill in our journal entry. And so from there, our interest expense is based on the 49.96. The amortization of the premium is based on the 4 cents per bond, and the payment is based on $50 per bond. So again, hopefully pretty straightforward. And then we got a couple more of these lectures before this chapter will be buttoned up. Thanks.